bring in Cantor Fitzgerald, head of equity derivatives and cross-asset strategy, Eric Johnston. Eric, so just for the record, you've been bearish pretty much all year. It's been a good call, and then turned tactically bullish, what, a few months ago? And now you're switching it up again?
Yeah, so early October, Sarah, thanks for having me. So early October, when the S&P was at 3,600, we closed our bearish call, called for a tactical rally. And essentially the reasons were we thought that positioning was quite offsides. CTAs were very short, hedge fund net exposures were at the lows. And we thought between short covering and then also we thought that the market would get to a place where they would think the Fed is almost done and that real world inflation is falling. So fast forward to where we are today at 39.50. Yes, so that all happened. And you know, if you look at CTAs as an example, they've bought over $150 billion or more worth of global equities over the last month. Hedge funds have covered a fair amount of shorts over the last week and a half, bringing their net exposure up. And we think that buy demand is now in the late innings, possibly 7th, 8th, or 9th inning of happening. And so now, and by the way, now people think the Fed is almost done and inflation is falling. So that's now all priced into the market. Now looking forward, the forward outlook fundamentally is very poor. And we can get into it, but it's essentially earnings estimates are far too high, valuations are far too high, and the economy is at significant risk over the next 6 to 12 months.
But if we have seen the highs on inflation, doesn't that suggest that the Fed is going to slow down? December, possibly go 50, maybe another 25 or so, and then pause. And so with that trajectory, if bonds are done selling off, wouldn't that be good for stocks?
So one of the interesting things is that we looked back at all the times where inflation has spiked to levels that we're seeing, approximately now. And when inflation then falls off, earnings get hit with it. And this is a very important point. Earnings benefited from inflation over the last year and a half. And when inflation rolls over, then all of a sudden their wages are staying high and they're able to sell goods at a lower price. And all of a sudden you get margin contraction. One of the things that's happened in history is that in 1994, for example, they raised rates, the Fed paused, and then we ripped in 1995. However, that was coming off of a 13 multiple, okay? And the same thing happened in 06, that was coming off of a 14 multiple. We're now at a 17 multiple, one of the highest multiples.
You just think stocks haven't gotten cheap enough?
No, exactly. They're not pricing in. So yes, it's great that the Fed is done, but the market's not like the market's pricing in recession and now the Fed is done. They're actually pricing in, based on where the multiple is, almost a soft landing, yet we still haven't felt all the effects from the hikes. And by the way, on December 14th, I expect Powell to remain hawkish on December 14th.
I was just going to say, it's not even clear that they're done. The Bullard comments certainly shook people up today, saying that we have to go to at least 5 to 5.25%, and probably should be higher than that. He only gets one more vote, though. He votes in December, and then next year he's not a voting member. So I still think he's kind of an outlier on that view that that the Fed should be looking at models here. But I guess to the point, Eric, they're not done.
Exactly. And I would agree with that. I think, on December 14th, Powell's going to be looking at the unemployment rate at 3.5%. He's going to be looking at the S&P 500, which currently is at 3950. I think will be much lower by then. And looking at an economy that's going to put up GDP in the fourth quarter somewhere around the 3-4%. So he's going to have the green light to be as hawkish as he wants. And I think he will take advantage of that. So despite the fact that we think inflation's falling and we're seeing that in the real world numbers we're looking at, that's beside the point because he's in charge. And that's the way that we think it goes.
The pushback on your argument, Eric, is that we really could have either a soft landing or a mild and moderate recession, that consumers are in better shape than other times we go into recession, that corporates are in better shape than other times we go into recession, that the credit market hasn't really flashed any super troubling worries, all of that to suggest that it could be a buying opportunity.
So I think that argument is very valid, not the buying opportunity part, but the part about the potential for a soft landing. You can't, I don't think you can rule that out.